Hello everyone, welcome to the channel of Wall Street Mojo. Friends, today we are going to learn a thing called comparable company analysis. This is basically a beginner's guide. This is basically a part 2 of the equity valuation series articles. Comparable comps is nothing but identifying doing relative valuations like an expert to find the fair value of the firm. The comparable comp process starts with identifying the comparable companies, then selecting the right valuation tools, and finally preparing a table that can provide easy inferences about fair valuation of the industry and the company. In this tutorial, we will discuss the following things. What is comparable company analysis? How to read them? We are going to see the box IPO's comparable companies analysis, how to identify comparable companies, how do we prepare professional comparable company analysis table, and any important adjustment in the comparable company analysis. In order to fully understand this concept, you should have a reasonable knowledge of relative valuation multiples like EV by EBITDA, P ratio, price to book ratio, PEG ratio, etc. However, if you want a very quick refresher, you may refer to the part 1 of the equity valuation series that was covered under the topic of relative valuation multiples. What is exactly the comparable company analysis? Also, it is known as trading comps or comparable comps. See, comparable analysis or trading comps can be best explained with the help of an example. Let's assume that you are planning to buy a house in New York. Why not? Who doesn't like that? Obviously, you may search on the many real estate brokerage website, and you would also draw a comparative study on the same. You would compare one apartment with another and would also try to get a sense of what they are worth as compared to each other. As you can see over here, when you are comparing apartments, you would consider different attributes such as number of rooms, size of bedrooms, number of bathrooms, layout, etc. In doing so, what you would notice is that apartments with similar kind of attributes may cost similarly. In this context, let us now try and understand what is comparable company analysis or comparable comps. Below is the basically a definition that we are going to discuss, which is sourced from the Investopedia. It says that process used to evaluate the value of the company using the metrics of other business of similar size of the same industry. Comparable company analysis operates under the assumption that similar companies will have a similar valuation multiple such as EV by EBITDA. Analyst will compile a list of the available statistics for the companies being reviewed and will calculate the valuation multiples in order to compare them. From the above apartment related discussion and Investopedia definition, we can draw the following inferences regarding the comparable analysis. Just like comparing the apartments, comparable company analysis helps you to compare different companies with similar size and industry and derive a fair value for them. Instead of looking at the number of beds, location, bathroom, etc., you look at relatively valuation P multiples like EV by EBITDA, PE, P by P book value ratio, etc. Third, you infer from such comparison regarding a company's price is overvalued or undervalued. I guess this, with the basic analogy, we should be able to proceed and move forward to reading the comparable company analysis. How to read the comparable company analysis table? For learning to read to comparable company analysis table or comparable comps, I'll take a real life example of boxing that had earlier announced its IPO. We want to understand at what valuation price point should we invest in boxing IPO shares. Below is the comparable company analysis table for boxing IPO, and there are broadly 5 parts to the trading comps. First, the comparable information. This includes company's name, ticker, okay, be very sure what I'm saying, name, ticker, price. Ticker is a very unique symbol given to the company to identify public listed company. You may take Bloomberg, Reuters tickers as well. Also note that the prices that we take here are the most recent prices. We make the table in such a way that these prices are linked to the database where they would get updated automatically. Second, size of the company. This includes the market capitalization and enterprise value. We normally sort the table on the basis of the market capitalization. Now, market capitalization also provides us a pseudo for the size of the company. Enterprise value is the current market-based valuation of the firm. Now, we may not want to compare a small market capitalization company with a large market capitalization company. Third, valuation multiple. This should include 2 to 3 appropriate valuation tools for the comparison. We should ideally show 1 year of historical multiple of and 2 years of forward PE. That forward PE multiple will be estimated. Choosing an appropriate valuation tool is the key to successfully valuing the company. 4. Operating metrics. This may include fundamental ratios like revenue, growth, ROE, etc. This is the important so that we can understand the fundamental of the company at once. You may include profit margins, ROE, net margins, leverage, etc. to make the comp more meaningful. Fifth, the summary. This is simple: mean, median, low, high of the above metrics. Mean and median provides core insight to the fair valuation. If a company's multiple is above the mean median, we tend to infer that the company may be overvalued. Likewise, if the multiple is below the mean median, we may infer undervalued. So, high and low also helps us to understand the outliers and a case to remove those if they are too far away from the mean and median. Now, reading to the trading comps or comparable company analysis of box IPO, let us know now look at the summary of the comparable company analysis of IPO, box IPO. The cloud companies, they're basically trading at an average of 9.5x EV by sales multiple. We note companies like Xero in an outlier that trades around 44x EV by sales multiple, expected 2014 growth rate at 94%, and lowest EV by sales multiple is close enough to 2x. So the cloud companies trade at EV by EBITDA at 32x. Now box valuation. From the financial model of the box, we note that the box is EBITDA negative. So we cannot proceed with the EV by EBITDA as the valuation tool. The only multiple that is suitable for the valuation is EV by sales. Since the median EV by sales is around 7.7x and the mean is around close point to in the neighborhood of 9.5x, we may consider making three scenarios for the valuation. Optimistic case, that is 10x EV by sales, base case 7.1 into EV by sales, and pessimistic case of 5.0 EV by sales. Now, as you can see in the table, that it shows the per share price using the three scenarios. 𝐂𝐽 valuation range from 15.65 pessimistic case to 29.38 the optimistic case. Most expected valuation for the box 𝐂𝐽 using relative valuation is 21.40 expected. Now, how to identify the comparable companies? The most important element of the comparable analysis is to identify a right set of comparables. Comparing value of apple to oranges does not make any sense here. It is important to conduct a preliminary study on the comparable companies, and it generally involves just three steps. First, identify the industry. Try to zero down the industry in which the companies are classified. This can be tedious as different sources would give different industry for the same company, and also industry names would be different in various sources. Generally, the classification available are very broad ones and cannot be relied completely. If there is no surety about the industry classification, which is the case most of the times, try to identify some keywords relevant to the business description of the companies. Example, building material companies, like the relevant keyword can be roofing, plumbing, framing, insulation, tilling, construction service, and so on and so forth. Though this example is simple, however, for applying the same in the real life scenario, one needs to establish the value, and the value of the driver makes several adjustments to it. B. Understand the company description. It is important to understand the business in order to select the comparable company. Try to find out the exact business description of the company. Possible sources for in the order of preference would be comparable company website, research reports, company filings, latest 10K, annual report, etc. like Yahoo Finance. Note, company websites are very useful in helping to visualize all the products and service, but the research reports and company filing provide actual segment data to give a true business mix of the company. C. Identify the key competitors. Comparable company can be identified from the following sources in the order of preference: research reports, company filings, that is competition section, Yahoo Finance, that is competitor and industry sections, and Hoover's, that is competitor and industry section. Now, professional comparable company analysis, a step-by-step approach. Okay, the key to preparing comparable company analysis or trading comp is the arrive at the right multiple, that is EV by sales, PE, etc. Now, as you can see, this is a particular set of company analysis. The requisite output of the company 1, 2, and 3 is linked from the input tabs company 1, company 2, company 3 respectively. Preparing the comparable comp table is not difficult. However, correctly calculating the requisite valuation multiple sometimes is challenging. Hence, we will focus primarily on correctly calculating this multiple with in-depth example. Okay, and for the same, you can either download some Excel template which is available to you, and you can practice that. What are the key formulas that I use? See, the basic equity value is what, let's go and quickly calculate. The basic equity value is going to be the common shares outstanding into the share price. Okay. The diluted equity value is going to be the diluted shares outstanding into share price. Now the diluted from the options. Okay. that is going to be options less the options into exercise price divided by the share price. The dilution from the convertible bonds into the conversion ratio. The enterprise value is going to be equity value minus cash plus debt plus minority interest plus preferred stock. For the dilution calculation above, the exercise price or conversion price needs to be below the share price. If the conversion price or the exercise price is above the share price, then there will be no dilution, an option will not get exercised, and conversion of the bonds will not take place. Comparable company steps: input basic information, input balance sheet information, then calculate in the money stock options, calculate in the money convertible security and find the diluted EPS, calculate the LTM numbers, X non-recurring items, calculate the equity value and enterprise value, calculate the respective multiples. Okay, let us now proceed step by step to understand this fully. I have basically taken an example of Robert Half International, ticker RHI, and even though the data used here is pretty old, 2006 10K and 10Q, those are the filings, I'm sure it will still prove to be useful for understanding the general methodology. Now the step one is going to be the input, the basic information for a company, the last fiscal year end and all the details. These are all the basic details that you have entered. Populate these fields manually, and this will be calculated subsequently because this option, warrant and convertible debts will be calculated. Step 2, input the latest available balance sheet information like cash, total assets, total debt, minority interest and preference shares, total equity shareholders and capital invested. So post the Q1 financial 07 filing, RHI announced the acquisition of some of the small staffing companies worth of $47 million. So acquisition was assumed to be financed from cash. So that's why there is a negative cash balance. Now, step 3, calculate all the money, the stock options. Over here, all the details of the stock options will be given. Here there is a little bit of dilution, will have a dilute effect on the common outstanding shares. Okay. Now calculate all the in the money, step 4, in the money convertible securities. For RHI does not have any convertible debt for convertible preferred security, as you can see the data. So as with the options, you only get dilution from the convertible bonds if the company's current share price exceeds the conversion price of the bond. Okay, how you factor the convertible bonds into enterprise value? If the convertible bonds are in the money, they can convert to shares. Then you can calculate the dilution and add it to the shares outstanding. If they are out of the money, they cannot convert into shares, and then you count the bonds as the debt instead. So dilution of the convertibles is equal to close enough to convertible bonds into convertible conversion ratio. Convertible bond is equal to convertible dollar amount divided by the par value. The conversion ratio is equal to the par value divided by conversion price. And the conversion price is equal to the par value divided by the conversion ratio. Now the most important, that is the step 5, calculate the LTM number, that is X non-recurring items. Now if you're wondering what is non-recurring item, then you need to understand all those items which are not going to repeat in the near future, or which is not going to occur in near future. This is our step 5 income statement, how we are going to calculate the LTM, the latest 12 years data over here. This is the most recent period data, less the period ending 1 year prior to the most recent. Okay. Step 7 is to calculate the respective multiples. This was our step 6 is left, calculate the equity value and the enterprise value. We now know what is equity and enterprise value. Calculate the respective multiples. Okay. And those multiples, that is EV by revenue, EV by EBITDA and EV by EBIT, all those multiples you'll be able to calculate from this particular data. Okay. Now there are some very important adjustments that you need to take care of while analyzing, like item cash. What is the thing that you should note? Think of cash as a free gift. When you buy a company, it reduces your effective price because of you get the target's entire balance sheet as a part of the acquisition. And you need to subtract from the cash. Okay. Now there is one additional info for the cash. You almost always include the short-term investment as a part of the cash number, but long-term investment depends on the liquidity and what your bank usually does. Second, debt. Debt refers to the loan that a company has taken out. Normally when you buy a company, you are required to refinance its debt, so it's counted as one of those of the hidden costs to make the acquisition. And this thing you will have to add some additional info on particular debt. All debt related items should be counted in this number: short-term debt, long-term debt, revolvers, mezzanine and so on. The only exception, convertible bonds, which may or may not be counted. It's better to use market values for debt. But if you don't have them, you can just use what is listed on the balance sheet, that is book value. Preferred stock. Preferred stock is very similar to debt. Investors receive a guaranteed dividend, usually in the form of interest rate on the preferred balance, and this particular thing you will add. Some additional info on the preferred stock. Preferred share is listed on the liability and the shareholders equity side of the balance sheet. Now, next, minority interest. When you own more than 50% of the another company, minority interest refers to the percentage that you don't own. So you need to add it back to the enterprise value because the other company's revenue and profit are included in your own financial statement. So you need to make sure that its value is reflected in the EV. And this particular thing you need to add. Some additional info on minority interest. Minority interest is listed on the balance sheet under liabilities or shareholders equity. In most cases, you are fine listing what's in the filling, but if you have market numbers, you can use them absolutely. Okay. Now, this was it for comparable company analysis. I hope you have got the best of the best knowledge from here. Thank you everyone for the tutorial.